Well, let's bring in the man who literally wrote the book about Disney, New York Times columnist and CNBC contributor Jim Stewart. Jim, it's always great to speak with you. Hi, what'd you make of the quarter, and what'd you make so far of Bob Chapek's performance? Jim? I think that we've lost Jim. We'll try and iron that out. Guy, you agree with Grasso, mid-80s?
Yeah, well, listen, I do absolutely think it could have a $90 print. So mid-80s is not unreasonable, especially if you think the broader market, for whatever reason, we just hang around this S&P 500 level at 50% retracement. But if you think there's a downturn, I think mid-80s is absolutely in the cards. Again, The Last Dance crushed, and I know you've been watching the last 3 Sunday nights. You're locked in for both episodes, for both 2-hour episodes, as you should be. And it's clear that Dennis Rodman was the glue. With that said, I'm not hurtling myself back to any of the Disney World openings anytime soon, specifically Shanghai on May 11th. But whenever Disney World or Disneyland reopens, and I don't think I'm alone, and I think that's sort of the point Karen's making. So I think you're going to have an opportunity lower. In my opinion, lower is around $90. So
I
yes.
actually missed last weekend's installment because I was doing the Gene Wilder movie marathon, as per your recommendation, Guy. But in terms of reopenings, Tim, we're getting word here that the Shanghai parks will reopen May 11th. Could we actually see a faster bounce back? Granted, with some masks, social distancing, all those things in place, but maybe we get a better idea of Disney's business sooner than we all think.
Right. So 36% of the revenue are their theme parks and their consumer experiences. The U.S. is clearly the lion's share of that, but Shanghai is very important. And what we're also starting to see, though, the anecdotal kind of news flow out of China is that people are being cautious, and rightly so. But leaving that aside, it's encouraging to hear things getting back to normal. It's encouraging to know that the other side of this is not just that Disney Plus is better, but look at media. Look at 28% roughly up in their media, 17% in their cable. So these are at least encouraging numbers in the face of what's a very difficult quarter. I think the new normal for Disney means most folks, and I'll listen to the analysts on this, but that normalized EPS, you have to wait until kind of late 21, if not 22. And I think the market is okay with not pricing Disney at a current earnings multiple. But again, what's that number you put on this? And I think that's how the market that will differ between whether you're a bull or a bear, frankly, because there's a lot of leeway in there.
Tim, late calendar year 2021 or 2022? That's what you're saying, to get a better idea of Disney's normalized earnings.
Yeah, I think normalized earnings, based upon what we kind of know about what we don't know, is probably late 21.
Mm-hmm. Wow. All right. Now let's bring in Jim Stewart of the New York Times. We got him back. Jim, great to speak with you.
Yeah, good to be here, even remotely in a rural area. I'm sorry for that connection. But, wow, there's a lot to absorb here. I had been talking to some Disney executives even before these earnings came out, and they were, as some of you have pointed out, they were leading me right to the balance sheet and saying they are really worried. And they've got, over $80 billion of goodwill, most of it from the Fox acquisition. They've got $38 billion in debt. They just took out another $6 billion in debt, and now they're suspending the dividend. This really is a cash crisis for them, a liquidity crisis. And I know there's a lot of worry inside the company.
So based on your reporting, Jim, and given the news tonight about the suspension of the next payment of the semi-annual dividend, you would say this is a liquidity issue facing Disney at this point, or will soon be?
Yeah, I think it is. I don't see how you can view it in any other context. Everybody's pointed out there. I've been a fan of Disney recently. I think they've done a lot of great things. The brand is great. But they are being, hit, as we now see. Remember, all this, the shutdowns really only came, for the most part, in mid-March. So most of the quarter, they were going right along. And you see what a massive impact. It's going to be much bigger this quarter, even under the most favorable estimates. And the question is, do they have the strength to get through this? And again, it's amazing that we're even talking about this, given that it had a legendary balance sheet. But it did decide to take on all that debt and add all that goodwill to its balance sheet in the Fox deal, which a lot of people had doubts about even when it happened. But now, through no fault of theirs, of course, the timing looks absolutely horrendous. And I think, yes, they are doing what they can. Good for them. They're raising the debt when they can. They're cutting the dividend when they can. They may have to cut it again. The question is that enough? And that's something investors, I think, are going to be very nervous about.
Tim on our panel was just saying that perhaps we don't get an idea of what Disney's normalized earnings are until late calendar year 2021 or even 2022. What does a Disney look like under that scenario? In other words, what sorts of cuts, in your view, will they be making first? Where are their priorities? Will it be, for instance, spending on a streaming service that doesn't yet make money but is the bet of the future? How should we look at Disney?
Well, I think that's going to be a big problem for them because, they were going to head to head with Netflix and Amazon, and they have, massive resources. They're spending billions of dollars a year on original programming. And Disney probably never had to spend as much as they did, given their legacy brands, but they were going to have to spend a lot of money to stay in that game. And they're doing great there. The numbers are very impressive, but if they have to pull back on that spending, and I think if they very well might, that is going to be very hard for them to compete. That was always going to be a low-margin business for the foreseeable future because it does require so much investment in original program if you're going to keep up with them. So I think they really can't afford to cut there, but they may have no choice. I mean, they furloughed employees. They've reduced the fixed costs as much as they can, but I just don't see where they're going to get the cash flow to ramp up the kind of investment they really need to do in the Disney Plus area.
Jim, thank you so much for your analysis. Always a pleasure speaking with you.
Sure, great to chat with you.
Jim Stewart of the New York Times. Disney shares in the after-hour session plumbing after-hour session lows, down 3.2%. Karen, Jim had mentioned facing a liquidity crisis, which is really, it is unbelievable. It is stunning to put liquidity crisis and Disney in the same sentence, when just 6 months ago it was a completely different story.
Right before Fox, but I was just looking while Jim was talking on some Disney bonds, and actually them cutting the dividends is good for the bonds. The less money going out the door, the better. But some Disney paper traded down to the mid-80s during the worst of March, and then rallied back all the way up to close to par. I'd be curious where it trades after this earnings report. It is astounding, though, that we even have the like you're saying, liquidity crisis at Disney. They have so many levers to pull, though. They could issue more debt, and they could issue equity. I don't think that's happening at all. But there are a lot of things they can do, and I know cutting corporate overhead, but still, they've got to spend. This is really not the where Bob Iger thought he would be 2 months or 3 months after stepping down at really what was the top of his game. May still be at the top of his game, just not at the top of Disney's evolution right now.